what I find really interesting is the cumulative returns over the last now 29 years from Nifty and the ISEC sovereign bond index are basically the same.
They are the same.
They are the same. Give or take, right?
Yeah, sure.
And that incidentally was true when we started Axis Mutual Fund in 2009. I looked at the data from 1994 to 2009. The returns were broadly the same. And now, 14, 15 years later, 1994 to 2023, roughly the same. This is not something which resonates with anyone, because it's like you said, the gospel truth is equities are the best way to make money in the long run. I think equities, yes, is probably the best way to make wealth. But when we look at equity performance or when we look at asset wealth creation, we look at the data that's available to us. Right? We have data from India. Obviously, we are in India. We have data from India. We look at the rest of the world and we look at, for example, data from the US, which is the market which is the deepest, largest, and the best researched. And this returns from the S&P 500 have been spectacular over the last same period of time, 10, 20, 30 years. But if you look a little wider afield, it's mixed. If you look at countries other than the US in the Western world, for example, the UK, you look at the FTSE 100, you look at France or the CAC 40. Come to Asia, look at China or Hong Kong and many of the Asian countries. The returns over the last 20 years have been meh. For practical purposes, many of these indices are trading at the same levels they were trading at in the late 90s. 20 years ago. So they made no returns over really long periods of time. And that, of course, this is related to economic performance. The fact that the US has done well, the fact that India has done well means that the stock markets here have done well in relation to countries which have not done as well. China is an exception where the economy seems to have done well, but the stock market has not performed really well. What I'm trying to say is not to say that fixed income or bonds are likely to outperform equities. Far, far from it. I still believe that equities is a great asset class. But what I'm trying to say is that we should not get carried away to make it a gospel truth that equities is the only way to make money. And it's very important to have a so-called asset allocation approach, which is to basically make sure that you have enough of different asset classes in your portfolio, because these asset classes perform differently across cycles.
Yeah, great. Siva, you kind of mentioned a fact which is a little incredible, and so I just want to ensure that I understood it right. So, government bonds between Indian government bonds between 1994 and 2023 have broadly given the same returns as Indian equities between 1994 and 2023.
Yes, just comparing one index which existed from then, because we don't have, many bond indices don't have 30-year history. So, the one index which does have that history, and of course Nifty, again, going back to the same period of time, caveats apply, like I said, past performance, etc. So there are very important caveats. Yes, but so the cumulative returns does look very similar.
And because this is government securities, is it right to say that it has come at a lower risk?
Yes, obviously in terms of government securities cannot default, right? So therefore, there's no credit risk. The volatility is much lower than equities. So obviously, from a price risk as well as from a credit risk, or from a potential loss of capital, obviously investing in bonds or investing in GSEC specifically is much lower risk proposition. Again, I'll caveat this by saying it's not to say that this is lower risk and better returns or whatever it is, right?
Absolutely.
So we shouldn't read too much into it, but yes, over this period of time, that's been the case. What is really interesting is, so this is point to point. So obviously there's going to be a question that's raised that, what happened in 1994, what happened in 2023, that's the reason why these are looking similar, and that's a fair question. So instead of looking at a cumulative 29-year returns, if you break that up into 5-year rolling periods, so you look at every month and then look at the 5-year past performance of future performance, whichever the case you look at it, and compare the two indices, you find that equities outperform maybe 55-60% of the time. That's just slightly better than a coin toss. So which is another way of saying is, we are in 2023, and if you were to ask me 2023 to 2028, is equities likely to outperform bonds, I would say it's as good as a coin toss. right? That is an incredible statement to make. Now, the last 3 or 4 years, it is certainly the case that equities have outperformed bonds on a rolling basis.
Yes.
Okay. Given the spectacular returns that we've seen post-COVID, right? So obviously, the recent history is very much in favor of equities as opposed to bonds. But when you look at the longer period of time, there's a cycle. You see a cycle of outperformance and underperformance, and even on a 5-year basis, it's difficult to say one does better than the other. It really depends on the economic cycle. Take a look at what happened in 2008 or 2013 when you had large drawdowns in equities, or 2020 for that, when you had large drawdowns in equities. Those large drawdowns really don't happen in bonds, and really that's the real reason why this 5-year cycle happens.